Looking to begin your investment journey but don't know where to start? Let me show you the basics to how you can construct an investment portfolio. Welcome to another episode of Money Matters. This is a big and complex topic, so this video serves as a high-level overview and will cover the specific details in separate follow-up videos. Let's get started. First, you have to understand the four main asset classes: cash, bonds, property, and equities. The general rule of thumb is that cash is lower risk than bonds, which are lower risk than property, which are lower risk than equities. When investors talk about risk, we normally refer to fluctuations in price or price volatility, i.e. holding cash is relatively safe, its value will not drop if the market crashes. Bonds are also referred to as fixed income because bonds usually pay what's called a fixed coupon or fixed level of interest for as long as you hold that bond. A bond may have a set maturity date, and upon maturity, the investor will receive back the par value of the bond. The general consensus why bonds are deemed safer than property and equities is because you can rely on a fixed coupon, whereas rent and dividends are less reliable due to void periods and dividends being at the company's discretion. Furthermore, in the event of liquidation, bondholders will receive any distribution of assets before shareholders. Property comes next and has a more stable price compared with the highly volatile nature of equities. It does not get traded frequently like that of equities, although there are REITs which do get traded like equities. And there are fewer factors which affect the price. Equities, which are also referred to as stocks or shares, sit on top of the pile for risk. Economic factors, government policies, politics, acts of God are all factors which affect a company's stock price. Additionally, without any change to the company's intrinsic value, a shift in market sentiment can send its stock price tumbling down. It's not just external market forces that can affect the stock price, but internal factors could lead to a downward fall of the company. Think of Enron and its fraudulent accounting as an example, leading ultimately to its liquidation. Second, there is a risk to return relationship. The more risk you are willing to take on, the higher the potential return of your investment. Take this with a huge pinch of salt, however, as there are many variables that affect this general rule of thumb. The longer your intended time horizon for your investment, generally the more risk you are able to take on and therefore greater returns. Third, your intended investment time horizon affects your investment decisions. You need to decide how long your investment is likely to run for. The rule of thumb is that the longer your time horizon, the more risk you are able to accept. On the contrary, a very short time horizon, for example, 1 week, is more speculation than investment. With a significant time horizon, you can rely on the markets to eventually rise via a series of short-term ups and downs. You can see my video on why markets eventually rise on this channel. Fourth, diversification is often used to avoid over-concentration in any one market and therefore spread the risk. The easiest way to achieve diversification is to choose a range of collective investments, which are mutual funds and/or ETFs. You can see my video on active versus passive investments on this channel. To achieve diversification, it is important to gain exposure from different markets. Whilst markets are somewhat linked, you can escape a large loss if one market drops, but others remain resilient by having a diversified portfolio. You can, for example, buy from the S&P 500, which are US listed companies, and buy from the FTSE 100, which are UK listed companies, and buy from the Hang Seng Index, which are Hong Kong listed companies. However, be aware that not all US listed companies are US companies, for example Alibaba, and not all US companies are solely reliant on their domestic market. For example, nearly half of Apple's revenue is from the China market. At the end of the day, I hate to say this, but your perfect portfolio ultimately depends on your personal circumstances, financial objectives, and life goals. I'll talk about why it's important to set goals in another video. Once you have your portfolio, do not just forget about it. Keep an eye on it and review it regularly to ensure it is on track to achieve what you set out for it to achieve. So my fifth point is to invest time in understanding the changing market conditions and actively manage your portfolio to ensure continued performance. Do not set and forget. A buy and hold strategy does not mean you ignore it. It means you ride the markets, but sometimes adjustments are needed. So those are the very basics of constructing your portfolio. Whatever your portfolio looks like, I hope you enjoy many great returns from the markets and keep on building that wealth. Thank you for joining me on this episode of Money Matters. Ask me a question about your portfolio in the comments below. Let me know what other topics you would like to hear about in the future videos. Smash that like button, subscribe, and I'll see you in the next episode of Money Matters.